In this video, traders, let's look at how to reduce slippage. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me. All right, so slippage is kind of some of the things that are hidden costs that we don't consider. So let me just kind of define slippage and let's talk about ways to reduce it. So slippage is basically when you enter an order into the market, it's the difference between the price you enter the order at and the price you get filled at. So if you go and you buy something that's currently trading at 28.22, for example, and you get filled at 28.32, you've got 10 cents worth of slippage from a stock perspective. And we could use that in Forex and anything else as well. So we don't tend to realize it because, you know, when it goes into our trading blotter, it says we're filled at this, we're long at this price, and we use that as an anchor point to trade from and to understand how much profit we've got, etc. And we might go, oh, annoying, the slippage, but we kind of tend to forget it over time, and maybe it adds up to quite a lot depending on how active you are. Now, if you're super active, slippage is going to have a huge impact on your P&L. If you're not so active, not so much, but it's always worth reducing it. Now, you don't have to go crazy about it, and, you know, it depends on instrument you're trading, but, you know, you've got to be mindful of it in some regards. So the first thing is to use limit orders. You're not going to get any slippage if you use limit orders. I think that's obvious. The point of a market order is it says, hey, I don't care what price I get filled at, I need to get in now. So you're sacrificing price sensitivity for time sensitivity. In other words, I don't mind what price I get, but now is when I need my fill. Now. Whereas a limit order is saying, I don't mind how long it takes me to get filled, if at all, but I have to be at this price. So use that previous example, 25, did I say 28? Can't remember. 28, 22, let's say you could put a limit in for 28, 22. You're never gonna get your slippage because the order by definition says, hey, I want to get in at this price or lower in case of a gap, but no higher. So you're never going to pay more than 28, 22, so you're going to get no slippage. So something to consider. If you get a lot of slippage, use orders. And by the way, guys, you know, you can set up and play with limits that are very close to the market, or even limit orders that are above the market. Let me quickly go off piste a little bit here. So imagine you've got a market that's trading at 28, okay, I've changed it now, 28.88 to 28, 92, say. That's the bid and that's the offer. And you want to get in. Now, if you hit a market, you might, by the time it hits it, you hit it at 28.92, you might get slippage and get filled at 29, for example. But if you put a limit in, you could put a limit buy in, let's say you put a limit long in, and you put it at 28.93, that basically says, okay, fill me anything up to 93. So if it's still at 92 when it hits, you're going to get filled at 92. If it's moved to 93, you're going to fill at 93. If it's moved higher than that, you're not going to get filled. So you can play around with that. You can see I can make it 92, you can make it 95, you can adjust the kind of slippage that you're prepared to get, or of course you can bid at 28.88. So using limit orders is the obvious one. Not always the case with some things. We'll get to that in a moment. The other thing is don't trade thin products. If you're trading a thin product like a stock that's super thin, or even a stock that's got a wide spread. I mean, the other day I was trading this DDD, which is 3D printing company, US stock. It was going crazy at this point in time, but spreads were super wide. And so, you know, and it's thin as well. The order book, there's not many shares on the book. So if you're, by the time you're buying, the spread's wide, it's like a 15 cents wide spread, and it's moving, you're going to get a lot of slippage. So either don't trade them or be mindful that if you are trading them, you need to be more aware of it and start to use limit orders and things like that. The other thing is don't trade during volatile times. If you are constantly trading orders at the open or constantly trading orders during news like earnings, economic calendar earnings, economic data, should I say, that kind of thing, the market's moving quick, you're going to get slippage. By the time your order hits the server and comes back and all this stuff, you're going to get filled at a different price to the price you saw. Because in reality, the price you saw isn't the price that it's now trading at because it's changed by the time it's all got to you. So when it's very, very quick, you're going to get slippage. You'll potentially get slippage. So watch out during volatile times, or don't trade it if you want to reduce your slippage. The fourth thing I've got for you guys is what's your order size versus the size on the book. You might think that as a retail trader you never come into this problem, and you know, if you're trading cable, if you're trading USD JPY, you're trading Apple, you're trading ES, you're probably not. But if you start trading other things, like even so much as kind of crude oil, sometimes when it's active, it's a bit thicker depending on volatility, but you know, certain things that are much thinner, like specifically some stocks, you know, you might find that if you're trading what you consider to be even relatively small actually results in a bit of slippage because there may be only 100 shares on the offer. If you want to buy 500 shares or 1,000 shares, that might end up you getting slippage and getting filled at an aggregate average price across kind of multiple price levels. Unusual in some circumstances, but something to still watch out for. Watch your order size versus size on the book. Now, you might not have access to order book size, but then if you don't have access to that, you can kind of do trial and error and go, well, actually, you know, if I'm trading at this price, am I getting kind of a bad fill? Am I getting aggregate fill? And work it out back from that. But like I say, it's probably only relevant for certain US stocks, UK, certain stocks, to say in general, and some of the less liquid futures contracts if you're trading kind of a bit more higher size. And the final thing is consider using stop limit orders. So a lot of people get slipped on the way out. So this is really slips on the way in into the trade, but on the way out is where a lot of slippage happens, and that's when you're using a stop order, because a stop order is basically it's a trigger for a market order. So as the price gets to this level, then send a market order. That's all a stop does. Sends a stop sell, so you're long, you want to come out and lock in the loss, not get any more loss to the downside. The stop basically says at this price, fire a market sell-in. So it's just automating you being at the screen, seeing that price and hitting a market order. Now, of course, we come back to the point of you might get slippage, because you might get stopped. Your stop might be at 28.88. By the time it sees that, the order gets fired, comes back, gets your fill, it might be at 28.80. That's slippage. So one way of doing it, consider using stop limit orders. And if your broker supports it, a stop limit order basically says, hey, exactly it's the same as this, but the other way around, it fires a limit order in rather than a stop. So in other words, if it hits 28.88, it goes, right, put me a limit selling at 28.85. And again, you're not going to get any more slippage than 85, but the downside is you could not get filled on your stop. So it depends what you're trying to achieve. So consider using stop limit orders as a way if you're getting super slippage, or maybe, I'm put it on here, but break up your order into different chunks. So you go, okay, I'm going to get stopped out in this level, let's say between 29 and 28. That's where I want to come out. Obviously, if you're swing trading, this is only going to work. And stagger your orders so that the average order price you come out at works out in the wash. You're not just trying to get out of the whole lot at a specific point in time, which could be when the market's flushing, but could be when it's moving and it's extra volatile. The other thing as well with stops, you know, maybe don't put them in. Yes, there's an argument here that you could get caught out, but maybe don't get stopped out in the first hour. Make sure your stops aren't getting triggered at the open. Make sure they're not getting triggered under certain times. Economic data, don't use stops, accept some of the risk and volatility. I know there's a caveat to that and says, well, you're open-ended risk then, and I get that. But if we're talking exclusively about reducing slippage, it's possibly a good time to say, well, you know what? I don't really want to be firing stops in this. I'll take the risk of it being, detrimental to my account. But the plus side is that it kind of pings around and settles down, and maybe it's just a little wick that's going to catch me out. So, anyways, that's how do traders reduce slippage. Check it out. Let me know your thoughts in the comment section below. Take care. See you next one. Bye for now.